Welcome to the weekly update, where I'll go over the action in the market for the week of January 3rd through January 6th, and then we'll see how things are looking for January 9th through January 13th, 2023. It's been a while since I've done a weekly video update, but I wanted to go ahead and show you the charts, give you updates. Some charts really haven't changed all that much, where other charts, they've given us some more insight as to what's happening. But a lot of the environment that we've been battling with for 2022 and now into 2023 is not really changed all that much. Value is still leading, growth is still lagging, and a lot of the areas that folks were hoping might really catch fire and go higher, well, it's not really happening yet, but we'll have to look at the charts and see how things are improving. So let's go back and talk about what happened the first week of 2023. There was a rally on Friday, and this was really the reason why the stock market closed up for the week. We'd been chopping around and we're pretty much down on the week. Well, on Friday, the employment situation report came out. It was taken as positive, and the market really rallied off of that, and that's where most of the gains came from. During the week, the S&P traded below 3,800 back on Tuesday, and then on Friday, we actually pushed above 3,900 and then just closed a little bit below 3,900. On Wednesday, it was kind of interesting. We've been talking about this Santa Claus rally in the daily videos that I do, and right after we got done with that period, which is the last week or so of one year and then the first two trading days of the next year, yeah, we had a bit of an advance so that in the books it'll go down as a Santa Claus rally, but my gosh, it wasn't all that exciting, and we chopped around a lot, and everybody had to look, at least I did. I looked at this afterwards and I went, oh, I guess we had a gain after all. I mean, it wasn't really all that noticeable. And when you have this positive Santa Claus rally, this historically has been regarded as a positive sign for the start of the new year. Well, so far, the first week, we ended up almost 1.5% with the S&P. So we'll have to see if we can continue with that. The major indices, it was very choppy. They were just bouncing up all around. On the daily chart, we're not trending right now. The ADX that we use to measure whether we're in a trend or not in a trend, it's low and getting lower and shows that we're in a trendless environment. And if folks were kind of happy about something or sad about something, driven by the expectations around what's the Fed going to do? And it seemed like most of the week, the Fed, it's like, okay, they're going to keep raising interest rates. They're not really turning dovish. They're not getting very market friendly. Well, then you had this scenario develop again on Friday saying that, the employment situation report, although it was stronger than expected, and the market could have just tanked on that news, there was one little reading in there for the average hourly earnings that declined a little bit, and the market latched onto that and said, oh yeah, we're going to develop this scenario again that maybe the Fed won't have to raise interest rates as much as we thought they were going to, and the prices took off to the moon. And we've seen that over and over and over in 2022, only to have this dashed. There's really been no confirmation from the Fed. There's only this one report that a lot was read into it to make it sound like that. So everything could be easily reversed in the upcoming week because we're not trending. There's not a lot of conviction. We're getting really no signals from the Fed. It's just kind of pie in the sky hopefulness from some of the market participants that helped push prices up on Friday. Then we also had a stronger than expected ADP employment change report. That comes out before the employment situation report. And this showed that there were a lot more jobs available for folks than they had expected. And also the initial jobless claims, this really shrank in the last week. So this is like, okay, maybe the employment situation is still strong after all, and that will justify the Fed raising interest rates or keeping interest rates high. Also, we saw a narrowing in the trade deficit, which is showing weakening in global demand. So we're seeing more economic slowdown, but we're still seeing a pretty strong employment situation. And that's what the Fed's been using to push rates higher and to say we can't really even begin to stop raising interest rates, let alone help them to go lower until the employment situation is starting to see some weakness. And if you think about it, it's like the Fed is waiting for things to get worse for people before they do something about it. It's not real positive in that whole attitude, but that's the stance that they're taking right now. We had some Fed speak this week. The Fed president from Minneapolis, Kashkari, who's a voter now in 2023, said that he sees the Fed pausing and trade hikes at about 5.4%. And we've been all over the map. There's 5%, there's 5.5%. Well, here it's 5.4%. But at the same time, he also cautioned that rates could be taken potentially much higher if we're not really showing a slowdown in inflation. So yeah, how's that for, looks like we're going to get to 5.4, but if inflation is still high, we could pump it even higher than that. Some more speak that we got were the FOMC meeting minutes came out from the December 13th and 14th meeting. And the big line that the markets grabbed onto was, here's a quote saying, no participants, no, okay, let me try to say that right. No participants anticipated that it would be appropriate to begin reducing the federal funds rate target in 2023. What they mean by participants, those are the people in the meeting and specifically the voting members on the FOMC. They're not really discussing that they're going to really reduce the Fed funds rate throughout all of 2023. That was seen as somewhat negative. Also, we had the Kansas City Fed president, George, who's not a voter, said that she sees the Fed raising the rates up to 5% and then staying there well into 2024. So we're kind of all over the place with what people are saying. St. Louis Fed President Byrd, who's not a voter, said while the policy rate is not yet in a zone that may be considered sufficiently restrictive, it is getting closer. Okay, kind of ambiguous, but the market took that as more positive. The report that came out that I mentioned a minute ago, it was not as strong as it was as feared, but it was also not very weak at the same time. The market liked that the average hourly earnings growth rate moderated to 4.6% on a year-over-year basis. The last time we had this report that came out, it was at 4.8%. The ISM non-manufacturing index, it fell below 50, and that means that there is a contraction in the economy. So we're seeing some economic slowdown, which the market kind of is taking bad news as good news right now. They want to see some slowdown. They want to see the employment situation calm down so that the Fed may not be as vigilant with their interest rate hikes. Then there's some negative stock news that came out that also drove the market. Tesla had pretty disappointing fourth quarter deliveries and reportedly will cut their prices in China. Okay. Apple told suppliers to build fewer components for several devices in the first quarter due to weakening demand. That's not very good news. Amazon announced plans to cut about 18,000 positions. Now, sometimes that's taken as positive because that's seen as getting rid of dead wood in a company. But right now, that's seen as more negative than positive. And then Salesforce announced that will be restructuring their company in an effort that will include the elimination of about 10% of its staff. So we're seeing a lot more of this news about layoffs, about slowdowns, about lowering productivity, and that feeds into a weakening economic climate. So for the week, the S&P ended up being up 1.45%, and most of that was really gained on Friday. Volume was below average because we're still kind of coming off that holiday. Plus, it was a shortened week. We only had 4 trading days in the week. The technicals, we'll go through some of the charts. So there's kind of a mixed picture where we're seeing a lot more negativity on the daily charts, but with Friday's advance, a lot of improvement could be happening, but there's a real mix as far as the weekly charts are concerned. And this is all being driven by inflation and interest rates. That's the real focus. Our trend is weakening, but it is negative. And I'll show you the chart of the ADX. It's not only are we in a trendless environment in the daily chart, we're in a weakening trend on the weekly chart. Here is a 10-minute candlestick chart of the intraday action. We're about almost over to the left-hand side. Tuesday, this is where we opened up, and then we ended up going down on that day. Wednesday, we saw a bit of a bounce, and we almost made it back to the previous high from Tuesday. And if you'll notice, you look along the bottom here, we spent a lot of time bouncing off that 3,800 level. The Friday before New Year's, we hit that level. We actually broke a little bit below it on Tuesday. We danced along it on Thursday. And so far, that 3,800 level has been holding up. So if we really start going down, we'll want to watch that level. And then on Friday, this is where pretty much all of the gains were experienced with the solid up day. So the Dow was up 1.5% for the week, and it still has the best looking chart going back to the fall of 2022. The NASDAQ was up 1%, the S&P 1.4%, I have it at 1.45%. And the Russell 2000, the small caps, they were up 1.8%. So we're seeing a little bit of improvement with the small caps and with the mid caps, which a lot of times that could be a positive for the market. Don't have a lot to show here because the year's only a week old, but this is for the trading week. How did the major indexes do? With the small caps doing the best, the mid caps doing the best, that's black, followed by the small caps, then the NYSE, the S&P 500, which is pink, NASDAQ 100, and then the Dow, which had been the best, was the worst performing index of the week. Another look at this too is just where are we at going back to the beginning of the year? Not an awful lot of change here. These two charts are almost identical to each other because we're just beginning the new year. Usually what I do with this chart is I'll go back to the beginning of the year or to the all-time high to measure that. Well, not a lot has happened to really show a lot of difference in these charts. Looking at our different sectors, the sector that did the best was one of the ones that had a lot of weakness in 2022. Communication was up over 5%, and materials were up almost 3.5%. The financial sector, they're 10 out of the 11 ended up posting gains, with energy being just barely positive. The one sector that was down on the week was the healthcare sector. And this just shows, again, going back to the beginning of the year, those sectors that performed the best, with healthcare being the only one that was down, communication actually doing about the best. And these change all the time, and this will become more relevant as the year goes on. Also, the update from current market valuation still has us fairly valued when you take all of their indicators together and put it into one signal. This is called the aggregate index score, where as long as we're below this one standard deviation up and then minus one standard deviation down, that's considered to be fairly valued when you take all of them together. Now, to break them down, we have the yield curve model, which is very overvalued at this point. And a lot of that has to do with the inversion of the yield curve. And that's why we're getting this really high reading right now. The Buffett indicator, which looks at stocks and compares it to GDP, this is more fairly valued. It's just below this +1 standard deviation right now, a little bit below that. And so it's not considered overvalued. Then we have the PE ratio, which is also fairly valued right now. We're just a little bit below this +1 standard deviation. And then we have, and it's really hard for me to see this because I have other things hanging down here. The interest rate model is considered to be fairly valued. It's right at about the midpoint, so it's not extreme positive or negative currently. The margin debt, which the last time this was updated was at the end of November. With the market going down, there are fewer investors buying things on margin, so that's why this line is really declining, so that's considered to be undervalued. And the mean reversion model, how far is the S&P getting away from its normal price or its average price over a period of time? It's a little bit below this one standard deviation, so that is considered fairly valued. And as the S&P goes down, that helps this indicator stay fairly valued. If the S&P goes up, then we will start to become overvalued. Sentiment. As of Friday's close, we're just about in the middle. We're reading at 46, which is neutral. And here's a historical chart where we never got down to a real extreme negative reading, but we have been showing some improvement. And we've been kind of dancing around between being a little bit greedy, neutral, to a little bit fearful. And we're not showing anything extreme, either positive or negative currently. This is the weekly asset managers, and they're human beings too. And when the market's going down, this has a tendency to go down. It's just, if this is going down, that means they're selling. If this is going up, that means they're buying. We're not really getting a huge extreme reading right now, but it is kind of low at 38.79. We really take notice of this when it gets down to about the 20 level. That's when we use this as a contrary indicator. The Ridex bear bull ratio, and folks have been getting whipsawed all over the place. They get into a bearish fund and we go up, so they get into a bullish fund and we go down. It's like they're doing the exact wrong thing at the wrong time. But overall, folks are still fairly fearful, so they're getting more into the bearish funds, which make money when the market goes down, than they are into the bullish funds, which makes money when the market goes up. Every week we get the AAII sentiment survey. We tend to use this as a contrary indicator when it's giving us extreme readings. But if you look down here, we've been capped down here for a long time. This means that individual investors in this survey are quite bearish. And that means that they're probably out of the market, that they probably sold, because this group tends to be wrong most of the time. But look at how much time we've spent down here. And a lot of times, if you look in the past, where we would come down, set a spike, and then that would mark a bottom in the S&P. Well, with everything going down to sideways in 2022, we can't really use that as an indicator currently. And as far as the price action is concerned, we're not really hitting any kind of climactic reading. We're not seeing a washout where everybody just said, oh, I want out of the market. I don't care what it costs. Just let the pain end right now. Well, we've been chopping sideways on the daily chart, and that's starting to feed over into our weekly charts. Also looking at this is the credit spread between the risky loans and the not as risky loans. When this really starts to go up, that means that there could be economic problems, and the shaded area just denotes a recession. Well, we've been going up with this indicator recently, but we're starting to come back down. So this would suggest that things are still under control as far as this chart is concerned. Another chart that we look at is the Chicago Fed. It's the national conditions of the financial conditions. When we're below this black line, that typically means everything is okay. Not great, but okay. And we're still quite a ways away from this line. Another thing that I got from Isabel Net, and what I'm doing that is a little bit different than those of you that have been watching these videos, I'm trying to cut back on the amount of time that I spend on each daily video, because it takes me 6, 7, 8 hours to do a video every single day. Well, that's just too much. And I have other things that I need to do. So what I'm going to do in the weekly videos is go through the whole week of the Isabel Net charts and then try to pick out those ones that I think are relevant, and I'll go over them in the weekly video. And let me know if you don't think that's a good idea, or just what your thoughts are, if you have any. But this is suggesting that we have 50 states, of course, in the US, and a little bit over half of them are having negative growth right now. So this is showing that as a whole, about half of the states are starting to have some economic difficulties. This is another chart that I did show earlier in the week, where it's trying to measure out where would we go if there was no recession, and we stated a PE ratio of 22, and if we stated about the $205 per share, which is about what the market is figuring that stocks in the S&P 500 taken together, that's what they will earn. If that happens, then we still could go up from here, and we might get back up to about the 4,500 level. Now, if we did not have a recession and prices continue to fall, and we got down to a PE ratio of 17 while staying at the same $205 earning per share, then we would end up dropping down to about the 3,500 level. If we had what's called a soft landing, where the Fed can stop raising interest rates without damaging the economy, and we get down to a PE ratio of 15, we still keep the same $205 per share. That would get us down to about the 3,100 level. And if things turn really ugly and we get into a deep recession, by the time we get down to a PE ratio of 15, and let's say the earnings per share has been lowered to $160 per share, that could get us down to about the 2,400 level. So that's why a lot of folks are really freaking out of, are we in a recession? Are we not? Are we going to go into a recession? Are we not? Because that could have some major impact on stock prices. This is just comparing the ISM manufacturing, a very important report, with the Chicago PMI, and they have a tendency just to move hand in hand, where throughout a lot of 2021 and then into 2022, both of these have been declining together. That's why we watch the Chicago PMI, and then we also, of course, watch the ISM manufacturing PMI. And PMI is Purchasing Managers Index. This is another one that just shows, looking at the next 12 months, the PE ratio. Other times when the markets really hit problems, where we had the Asian crisis, we ended up coming down to a 17.3% PE ratio. We had the long-term capital management problem that just about took down the whole market. The dot-com boom and bust. Then we had SARS. And some of you, that these are like the good old days compared to the whole COVID-19 thing. During the great financial crisis, we got down to a PE ratio of 9. Then we had the EU sovereign crisis. That's where there was kind of an interesting Fed pivot during that point, but we got down to the 10.3 at that time. You had a lot of things happening in 2015. You had Brexit, you had problems in China, you had oil issues as well. We got down to a PE of 14.9, blah, 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 blah. I could just go on. When you average all of these together, we tend to get down to about a 14 to 15 PE ratio on average. Now, that's just an average. So it could go lower than that, or it could stay higher than that. But if you average where we're at right now, or if you look at where we're at right now, we're at 17.7. So we would have to fall to 14 to 15 in order for us to get to the average reading here. And that means prices would have to decline, or earnings would have to go up. Well, earnings are actually going down. So that means stock prices would have to go down even more to get to a more fairly valued PE ratio. This is the M2 money supply. This is measuring how much money is out there. As you can, during the whole COVID lockdowns, the Fed just threw massive amounts of money into the US economy. Other central banks around the world, they threw money out into their economy. This is quantitative easing. They were printing up money. There were stimulus checks. It's just crazy, crazy. That's where you see this big run up. So there was a real growth in the M2 money supply. Well, now they're starting to rein that back in. And as they're reining that back in, that could also have a real impact on the forward-looking earnings per share. And it only makes sense if you think about it, but we need to keep that in mind. It's like, why are prices going down? Well, a lot of the big macroeconomic things, they're starting to turn the other way to make it more restrictive, and that will ultimately go through into stock prices going lower. This is a chart that's very similar to charts that I show. This is a weekly chart, just has some moving averages on here and showing you some different support and resistance levels. And I really try to go through these in the daily videos that I do. I'm a big support and resistance person. I also follow a lot of moving averages. So I'm not going to go through and really explain this, but you might want to pause this and just kind of look this chart over to see if it gives you any kind of insight. We really want to see, if things start to go up, can we break through this trend line that's been coming down? That's kind of the big point right now. And do we want to stay above this green line, which is the 200-week moving average? That is very long-term support. This is just suggesting the back-to-back negative S&P return years, because we had a down year in 2022. They are rare, but the next chart down below says, however, the odds of a bear market remain high. So we don't see a lot of back-to-back down years, but as of right now, based on this chart, there's a 92% chance that we're going to have a bear market in 2023. This is the ISM Manufacturing Index. That is the yellow or gold line going down here. And then you have the S&P, and these tend to go hand in hand with each other. And this has been declining as the economy's been weakening. And that's another reason why the S&P 500 has been declining. Here's another chart. Again, you can pause this and look at it. This tries to compare value versus growth using the Russell indexes, where I generally use the S&P indexes, and it just shows that value was really outperforming growth. And there's been some tug of war in here, and we saw the real shift in early 2022, even going into late 2021. And that's why we're seeing prices really decline, because it's the growth stocks that really help give the advancements to the major indexes. Then this is looking at valuations and comparing them to secular cycles. Secular just means long term. And still, according to this chart, we are still in a secular bull market when you look at the very long term, but there can be cyclical bear markets within bull markets. And there's all the debate going back and forth. And if you're a doom and gloomer, you think we're in a bear market. If you are an eternal optimist, you think we're still in a bull market. And go ahead, debate that back and forth. What we do is we follow the charts day by day, and then they try to tell us what to do. And this just measures not so much the PE ratio, but the cap. This is like the Shiller PE ratio, very similar to the PE ratio, but measured in a different way. And where were the valuations at different times throughout the history of the market. This is another chart just showing temporary jobs. When we really start to see temporary jobs fall off, that typically happens right before a recession. This happened in about 2002. It also happened during the great financial crisis. Naturally, it happened during the COVID lockdowns. Well, we're starting to see this really come down as well. It hasn't dropped below this red line yet, but if it does, that may be another warning sign that we're headed towards a recession. Also, I like to go to the FactSet blog and read, and I don't have all of their articles. This is just one that I thought was interesting, and it's one of their latest ones. It just asks a question that says, have analysts lowered the earnings per share estimates more than average for the S&P 500 companies for the fourth quarter? To answer that in a nutshell, yes, they have. And that's the reading way over here. This just shows that earnings per share has been lowered in their estimates. And again, that is justifying stock prices going lower. Now, getting into some charts. Here's the VIX, which measures fear. And this has really been acting strange. As we were coming down with the S&P 500, the VIX really wasn't spiking up. And here is the line chart, which just shows you the closing basis. And here is the bar chart, which gives you the open, high, low, close. And we're still down very near the 20 level, which is more complacent. When this really goes up, that means there's a lot of fear in the market, and the VIX has just not been measuring that. And I talk about that more in the daily videos. This is another gauge of looking at fear. It's called the ulcer index. When it goes up, that means you're freaking out, you're getting an ulcer. Well, it's been coming down as well. I also show this a lot in the daily videos. And then I have this thing called possible positive scenarios. These are setups. These are things that when we hit these levels, a lot of times that marks a low in the S&P 500. Well, we've been chopping around for so long now that these scenarios and setups, they're not really even applicable, and they're not really giving us any valid signals right now. So if you want to keep up with those, and I have a lot of them that I look at and then I take them together, please watch some of the daily videos that I post. And because I try to stay right on top of those, but for a long time now, nothing has really been happening. Looking at earnings as well as valuation, this is the Shiller PE ratio that I just talked about a minute ago. We are right now at a reading of around 28, where the median and the mean is anywhere from 16 to 17. So this would suggest that the market is still overvalued using this method of valuation. The Fed, all right, as of Friday, it's still looking like there's a almost 76% chance that at the next Fed meeting, they're going to raise rates another 0.5% or 50 basis points. But this changes every day. So we'll start watching this. Once they raise the rates, we will be at 4.5 to 4.75% interest. This is the balance sheet where starting in 2022, the Fed was beginning to get rid of some of the assets that are on their balance sheet. And this just shows this going down. It's still very, very high, but it is starting to come down. Looking at breadth, where based on price, we're showing a little bit of improvement recently, and it's above this advancing moving average, where if you look at the volume down below, we haven't reached the moving average yet, but it is showing a little bit of improvement. And this green, this just shows that these are up thrust days. And we've seen a lot of those recently, but if you look right here, we've just been chopping sideways as far as price action. Then the advanced decline ratio, still leaning more towards the positive side, both with the 19 and the 39, they're above zero and advancing. New highs, new lows, seeing some new lows being generated here, new highs being generated here. So our 4-period simple moving average is just crossing back above the moving average. If we go back 10 weeks, it's starting to turn back up. So there's some improvement there. Accumulation distribution, we're above the moving average and showing a little bit of an advance. So that is somewhat positive. This looks at our trend. As long as we're above this blue line here, that means we're above 20. That means that we are in a trending environment. However, when this black line, that's the ADX itself, when that is declining, that means the trend is weakening, and there's a moving average right here. When we're below that, that just confirms that we're weakening. When we look at this to get a positive or negative slant, when the red line is on top, that means we're defaulting to a negative trend. When the green line is on the bottom, or if it then switches over to the top, then we would switch to a positive stance. But this just shows that it's a negative trend that's weakening, but we are still above 20. Then the Arun indicator, this tries to measure buyers against sellers. When the red line is pegged all the way near the top, that means that sellers are in control. When the green line is pegged all the way to the top, that means that buyers are in control. This oscillator down below tries to measure the difference between the two, and we're below zero, so we're negative, but it's been flat for the last number of weeks. The mass index, not generating a signal here. A signal that we get from this indicator is when it crosses above this red dash line and then above the blue line and then comes back down below the blue line. That's when a signal is generated. Well, you can see we're going in the opposite direction currently. Some long-term charts. First, I look at a daily chart where we're coming right back up to the pivot point here, and we've been in a trading range now for quite a number of days, and we're trying to ask the question, are we breaking out of this trading range? We came right back up to the pivot point. We're right back up to the daily 50-period moving average. Is that going to act as resistance and we're going to fall back down, or will we be able to come back up out of that? And then another thing to be aware of is we're pretty much in the midpoint of a trend channel going all the way back to 2009. We're just about in the middle currently. Pivot points for the whole month, we are below the pivot, so that is negative. And these don't change. Once they're on here, they stay on here for the whole month. When we're above the pivot point, that means we're more positive. When we're below it, that means we're more negative. Then we have resistance levels above and support levels below. Looking at just a 50-period simple moving average, as long as we're below that, that shows that we are negative. And I wish I could make this thing go away here. There, that might help it a little bit. Looking at the long-term trend, this blue line is a 13-week moving average. The red line is a 50-week moving average. And I use these two moving averages on pretty much all the charts that I'm going to show you. This just shows that the long-term trend of the S&P 500 is still down because the blue line's below. We have another indicator called the bullish percent index. And this is looking similar to the daily chart where we're below 50, but we are showing an advancement here. When we're below 50, that's negative. When we get above 50, that's more positive. And this just measures the point and figure buy or sell signals inside of the S&P 500. When this is going up, that shows internal strength. When this is going down, that shows internal weakness. Chaikin oscillator, looking at this in a long-term view, when this is going up, that is more positive, and that's what it's doing currently. Chaikin money flow, when this is above this level and turning green, that means that a lot of the big institutions are buying. Well, we're seeing some improvement here, but it's still negative overall. The force index also is just about at 0 right now. This would turn green and go up if this was turning more positive. McClellan oscillator, when we're above 0 and advancing, that's positive, and we're not giving a real extreme reading. That's when we get up to this blue line on top. The summation index, which gets itself from the McClellan oscillator, it's actually declining, but it's still above 0. Based on volume, it's showing a little bit of advancement, but it's below 0. So this is giving us a real mixed picture right now. Then I changed this up a little bit. I added a couple of oscillators to this chart, both on the daily, and then this is the weekly chart where we have the slope and the TSI. These are considered to be shorter term oscillators, and you can see one is going up and one is going down. The MACD, which a lot of you are probably familiar with, that and the PMO, the PPO, and the TRIX, these are considered to be, the PPO, these are considered to be intermediate term oscillators, where the MACD is rolling over a bit. The PMO is rolling over, not really strong right now, and the PPO is kind of rolling over, where long-term, we're showing some improvement with the TRIX and the KST. So we're seeing a real difference in the signals depending on which oscillator you look at. Here's the Swindlin trading oscillator, where based on price, it's showing some improvement and it's above 0, as well as based on volume. Here's a PMO study where it is showing some improvement here, but rolling over recently, but it's still above the moving average, but we're declining based on price and volume. So this is part of the mixed picture that I was talking about. The PMO studies, well, if you look at those PMOs that are rising, that's looking pretty good and not extreme. The buy signals are showing some improvement, and the PMOs that are above 0 are declining to flat currently. So this is showing some improvement here. The RSI going back 14 weeks, we're turning up, but we're still below 50. So it's still negative, but showing improvement. The Special K, which is a long-term oscillator, it has been declining for most of 2022, but it's still above this moving average. So it has a positive slant, but it is weakening. Stochc RSI, this is one of our shorter term indicators, which tries to combine stochastics and the RSI and put them together. It's turning back up and is more positive, and it's above the 0.5 midpoint. The Williams percent are also kind of a touchy indicator where it's also showing some improvement. The Vortex, we have the red line down and the green line going up, so this is turning over positive. The Ultimate oscillator is right about at the 0 point, but showing some improvement. The money flow is also showing some improvement and is above 50. The Bollinger Band's turning up across the midpoint. So you can see how we're turning more positive here, but we still have a lot of negative signs. The rate of change going back 1 week, that is also showing some improvement. Now going back 50 weeks, which is about equal to a year, after giving us an extreme negative reading in October, has been bouncing up off of that, even though it did fall back through a lot of December. The Copic curve, this is generating what could be considered a buy signal. When this starts to turn back up and crosses above the red line, you can see that often marks a low in the S&P, and this is really registering on the November low, and it's still been going up, but it takes a while for this indicator to pick up the weakness that we've been seeing through most of December. The weekly chart, we're still hanging in there. We're still above this 38.2% retracement level. And the important one is this 200-week moving average right here. If we really start to fall, we're going to be watching especially this 200-week moving average. Our different charts, the Heiken Ashi, that's giving us a doji sign. See, it looks almost like a cross there. It's not really an up or a down bar currently, but you could default more to the negative side because of these dark bars. The Kegi is also still positive because that's black. It'll turn red when it's negative, but it is declining. So it's positive, but showing weakness. The Renko with the open box, that is considered to be more positive. And the ease of movement going back 1 week is showing some improvement, and going back 14 weeks is also showing some improvement. And the point and figure chart, we're currently working off a high pole warning, which was generated back on December 12th. And then we're seeing an awful lot of zeros in here, but no recent signal has been drawn. The 3-line break is showing some weakness here with the dark bar, and it's trying to redraw some additional bars. Our different trading systems, our Elder Impulse system, it switched to blue, so that means neutral. And our parabolic SAR system, the dots are on bottom, and that is positive. When they're on top, that is negative. So this is still showing a positive trend. Looking at the broad market, here we have the S&P, here's the mid caps, and we just kind of look at this with no indicators, and then small caps on the bottom, just to see if we see any real major divergences here, where we're seeing a series, this really down trend line here. We're not really seeing that as pronounced with the mid caps or with the small caps. Looking at all stocks, they're still in a downtrend overall with the blue line below the red, but we are showing some improvement, and the shorter term moving average is trying to turn up. The mid caps also showing some improvement, getting back above this red moving average. Can it stay above that, and can we see a golden cross? We haven't seen that yet. Small caps also showing some improvement, but we're still in a downtrend overall. The Dow, it had a recent golden cross on the daily chart, and it's picking up that same golden cross here on the weekly chart. So this is looking more positive. The NASDAQ still has a lot of work to do. We're still in an overall downtrend. The NASDAQ 100 also in a pretty significant downtrend. The Wilshire, which is the broadest measure of stocks, that is still in a downtrend. NYSE also a very broad look. We're getting back above the moving averages. The shorter term moving average is showing some improvement, but it hasn't crossed yet. FANG, these are the big tech stocks, still in a pretty solid downtrend. ARK, which just has been having a lot of trouble here. And just as kind of a side note, one of the groups that I belong to on Facebook, it's an ARK group, and man, you should just hear people are so mad at Cathie Wood, just thinking that she just led them astray, and that everyone thought she was a genius when ARK was going up. The thing, it's not so much that bothers me, because she has a philosophy and she's willing to stick with it. It's that why are people losing money in ARK? You can easily hedge these things. There are very liquid put options that it might bite into your returns, but it would protect your capital. And this is a big thing that I teach in my classes, not only how to make money, but how to protect the money that you've already got in the market. And this just shows a lack of education when people just throw their money in, and it's like driving around without a seatbelt. Sure, a lot of the time it might work, but when things turn bad, it could really be very, very bad. And people need to learn more of how to hedge, and that's what I teach in the classes, because that's rule number 1 that I have is don't lose money. Rule number 2 is then make money, because we want to protect what we do have. And a lot of you spent a lot of your lives, 30, 40, 50 years, building up this wealth, and we hit a really difficult market condition, and you could see a lot of that just evaporate. That doesn't need to happen. There are ways to protect your investments. All right, just wanted to get that off my chest. All right, let's go to the next chart here. The biggest software companies, they're still in a downtrend as well. Looking at Dow theory, we're looking for either divergences, either positive or negative. Not really seeing too much, where utilities had been outperforming back in 2022, but not really seeing all that much right now. Looking at the broad market, this is the CRB. These are the commodities. And not so long ago, we had a death cross here. So this is turning into a downtrend overall. And then over on the left-hand side, it shows you the different percentages that make up the CRB index. Copper, generally, as copper's going up, that's showing an improvement in the economy. When it's going down, that's suggesting economic weakness. And it's been bouncing up recently, and we're still in an overall uptrend, but this blue line is really starting to come down. Gold, which of course it had an up week, and all the few gold people that I listen to, they're just ecstatic right now. They're just sure that this is going to be it. Well, we've seen these breakouts before, so we'll just have to see if it ends up following through on that. Silver also had a recent golden cross on the daily chart, and it's showing that same golden cross on our weekly chart. Oil has really been coming down lately, which is probably helping gas prices a little bit. And then the dollar, which had been just rip roaring up, has shown some weakness. And of course, the people who like gold think that the dollar is now going to just get flushed all the way down the toilet, where other people see us hitting potential support here, and we may get a bounce out of the dollar. Again, we'll just have to see how that plays out. Looking at bonds and interest rates, the total bond ETF that we look at is still in an overall downtrend, but showing some improvement. This is a thing called the MOVE index. This is like the VIX for bonds. And when it's getting up really high, that means the bonds are very volatile. And it's still giving us a pretty high reading, but it has declined from higher levels. And then this is a daily chart of interest rates, how they had been going up, but in the previous week, we have seen interest rates really come down. And that gave, especially on Friday, that really gave support to stocks. And then this is a weekly chart internationally, where the green, that's the US, the black is the UK, that's current interest rates there. The blue is Germany. And then we had some recent news about Japan, where they've raised the, I guess, threshold of how they're, or what the Bank of Japan is willing to allow their bonds to trade in, because they're starting to see some inflation in Japan. And so that's why you're seeing this go up. The big ones that we're really watching right now are the US, UK, and Germany. Japan's kind of in its own situation, and we're waiting to see how that will play out. Looking at the relative studies, this goes back to the beginning of 2022, because it would just be a really short little line here, showing how oil has still been doing the best, followed by the dollar. Gold is finally starting to turn positive. Stocks, that's the black line, they're still negative, and bonds. And then as we get deeper into the year, I'll adjust this chart. And then this is bonds to the S&P, just showing how bonds are still underperforming based on price. On a monthly basis, stocks have really been outperforming bonds, but we are showing some weakness. And then gold, which is starting to improve when compared to the US dollar after being in a pretty significant downtrend. And this is gold to the S&P, where gold has been outperforming the S&P recently, and we're in an overall uptrend. But this can be really, really choppy at times. Low volatility stocks, the ones that tend to hold up better when we're going down, they're still in an overall uptrend when compared to the S&P. Growth versus value is really underperforming. That means value is outperforming growth. And the NASDAQ 100 is really underperforming the rest of the S&P 500. The S&P 100 is massively underperforming the rest of the S&P 500. And discretionary, the things that make life fun, that's really performing staples, the things that you have to have. And energy has really been performing quite well, and is still in an uptrend when compared to tech. And tech is the big growth area, and it's really been getting hit a lot. So that's why you see energy really outperforming. All right, so what's our outlook then for this coming week, January 9th through the 13th? On Monday, we have consumer credit coming out. Tuesday's the NFIB small business optimism. And we'll get wholesale inventories as well. Wednesday will be the MBA mortgage applications index. Thursday, CPI. That's going to be the biggie. And we get the weekly jobless claims. But CPI is the big one. We'll also get the Treasury budget. And then on Friday, we'll get import-export prices. And then probably the bigger report is going to be consumer sentiment. We'll get the preliminary reading. So we're still in this mix of, we're negative overall, but we're showing some improvement. But the market's been so choppy and trendless in the daily charts, it's really been preventing the weekly charts from changing all that much. But it's still inflation and interest rates that are the big concerns. So our scenarios, and I'm taking this from the daily video that I do, we can't really go with the down scenario because the technicals are negative, but are showing some improvement. Can't really go with the up scenario because our technicals are negative and showing some improvement, but they haven't turned over positive yet. So we're still going with the sideways trend where the ADX, this is based on the daily chart, it's weakening and it's below 20, but it is positive. So thank you. Have a very good week. I hope you check out some of the daily videos that I also post, and I will look at preparing the next weekly video after this coming week.